Hello, and thank you for joining us today for our webinar, Four Provisions Real Estate Companies Need to Know from the Inflation Reduction Act. My name is Mike Kaminsky, and I'm the National Real Estate Practice Leader here at Baker Tilly. Baker Tilly is one of the top 10 largest accounting firms in the United States and has been named the fourth fastest growing firm, according to Accounting Today. Real estate and construction is one of Baker Tilly's largest industry focus areas, where we serve 5,700 real estate and construction companies worldwide. Our real estate professionals provide assurance, tax, and consulting services for our clients with a focus on enhancing and protecting our clients' value. We work differently here at Baker Tilly because we truly have a passion for assisting our clients with achieving and exceeding their goals. I'm pleased to introduce my colleague, Chad Resner, who is a firm director within our real estate and construction practice here at Baker Tilly. The IRA has created game-changing opportunities for real estate companies through $270 billion in available energy incentives. Over the next hour, we will dive into the provisions of the IRA that may impact your organization. We're going to try to leave some time for questions, but there's a lot of material to cover. For those who submitted questions already prior to the webinar, we thank you, and we will get back to you individually if we do not have time to address those on this call. For those who want to submit questions along the way, please do so via the chat. If you can, we'd prefer you leave your name, so if we do not get to them on this webinar, we can follow up again with you directly. Chad, I'll turn it over to you.
So a lot of people may have heard a lot about the IRA, or the Inflation Reduction Act. It's a huge bill. And this slide gives us a few little different provisions about it, or different facts about it, the funding, the size, etc. And again, there's a lot in the IRA, and there's things that could apply to real estate clients. But I think really where we need to focus is on these four things. And that's why we're going to spend our time today on these four items and things that are relevant to these four items. So the first one we're going to talk about is the 179D deduction for energy efficient commercial building property. 179D, the first one we're going to talk about, that is a deduction. So qualifying property put into a building is eligible for a deduction. Section 48, the investment tax credit for energy property, the main thing that's going to apply to is solar panels. So you can think basically solar panels are what you're looking at here for 48, and that is a credit. Section 30C, the alternative fuel vehicle refueling property, think electric charging stations. That's really going to be what that applies to. 45L, the last credit we'll talk about, is for new home energy efficient credit. So if a new home is built, can be multifamily, sold or leased, meets certain energy efficiency standards, there is a credit available for the sale or the lease of that property. Okay. So first of all, when we talk about a deduction or a credit, the difference between a deduction or a credit, a deduction, it reduces your taxable income, and then the tax is computed off of that amount. Now, when we have a credit, that is an actual dollar for dollar reduction in the tax due. So obviously a credit is better than a deduction. So the new law has made some changes to the carryback period for the credit. So it used to be 1 year that the credit could be carried back. So as of 12/31/22, there is now a 3-year carryback period for the credit. It goes forward 20 years, back 3 years. So a taxpayer that has a credit has a 23-year window in which they can use the credit. Most taxpayers are looking for an immediate use of the credit and don't really want to carry it forward for a long period of time. And so there's a couple new provisions that are enacted as part of the IRA, excuse me, that are actually very, very beneficial. Number 2 bullet point here is transferability. So credits can now be sold. So a taxpayer that previously was going to be carrying a credit forward, had no use for the credit, now has the ability to sell the credit. It is only certain credits, and it's got to be an eligible taxpayer. We'll talk about what credits can be sold and what are the eligible taxpayers. The one issue that's sort of out there, or an issue, I shouldn't say one, an issue that's out there right now with regards to the transferability of credits is, will the passive activity loss rules apply to the transferee? Now, this will make a big difference because if the transferee is subject to the passive activity loss rules and has to apply those rules and whether or not they can use the credit, you're going to have a smaller number of taxpayers that can be buyers. Where if those rules don't apply, you're going to have a larger universe of buyers who can buy the credit. So it will make a difference on who are the available purchasers of the credits. There will be comments going into the IRS and Treasury regarding all provisions of the IRA from a lot of different taxpayer sources, professionals, etc. Baker Tilly included. We are submitting a comment letter, and one of the things that Baker Tilly has specifically included in the comment letter is a request on the passive activity loss rules and whether they apply to the transferee, because it's really a big deal. So we're hoping to get guidance that's favorable from the IRS, but we're in a wait and see position right now. The third point here is direct pay. So tax exempt entities can be treated as if they made a payment to the IRS and then file a tax return and just get a refund. So the credit's treated as already been paid. They just file, get the money back from the government. One nice benefit for the direct pay is that it'll be dollar for dollar. Obviously, with the transferability of the credit, if it's sold to a third party, it has to be sold to an unrelated third party, there's going to obviously be some discount in that. We don't know what the market's going to be yet, but you won't get dollar for dollar for the amount of the credit. Of the credits that we are talking about today, the investment tax credit section 48 related to solar panels mainly, and the section 30C electric charging station credits are credits that are eligible for transferability and direct pay. So those are credits the taxpayer, if you're not a tax exempt entity, you can sell. Okay, here is a summary slide regarding the 179D energy efficient commercial building property deduction. So this is a deduction that is allowed for the cost of energy efficient commercial building property placed in service during the year. So what is energy efficient commercial building property? It is a specific type of property. There are three main categories we're looking at. You're looking at lighting systems. You're looking at number 2, heating, cooling, ventilation, and hot water systems. And number 3, you're looking at the building envelope. You're going to have a certification done, and there's procedures. We'll cover a little bit of that, not everything. But so you have to test, prove the efficiency, the reduction in your power cost, and things like that to be eligible for this deduction. So here we have columns for the prior law and the new law. So a requirement to even be allowed to take this deduction is there has to be a reduction in the overall energy cost. Now, for a new building, there's what we call like a baseline building. So there's a definition of that, and it's more specific than I'm giving here during the webinar. But you have this baseline. If you reduce the energy cost related to those 3 categories of property that I just talked about by 50% under the old law, you're eligible for the deduction. The new law, they have reduced the energy efficiency requirement to 25%. So once you hit 25%, you are eligible for a deduction. So the next line down we have is the maximum deduction. What that is it's a cap on the amount that can be deducted. So you deduct the cost of the energy efficient commercial building property up to a maximum number. Under the old law, that was $1.80 multiplied by the square footage of the building. Under the new law, we start with 50 cents per square foot, and you add 2 cents per square foot for each percentage of efficiency you gain from 25 to 50%. So you can get up to $1. That number gets changed. So we have on the next line, bonus 5x. So the 5 times bonus. This is something that applies to the wage and apprenticeship requirements. We're going to be talking about this a lot, and we have some slides specifically on the prevailing wage and apprenticeship requirements. These will apply throughout the IRA. The way these requirements apply here, so the 5 times bonus it applies to the maximum deduction or the cap for 179D. So instead of the 50 cents up to $1 per square foot, you get $2.50 per square foot as the starting point, and every percentage from 25 to 50% in efficiency gained, you get an additional 10 cents per square foot. And again, this just caps the deduction that can be taken. Under the old law, this cap number was reduced for any prior 179D deductions that had been claimed. So your cap can get down to a very small number. Under the new law, you only look at deductions taken in the last 3 years. The cap is reduced only by those deductions. There is a provision for a tax-exempt entity to allocate the deduction to the primary designer of the property, and we'll talk about that more. If you are under those rules, you have to look back 4 years for deductions. A partial deduction was allowed under the old law. So when we look at the 3 categories, if you didn't get 50% energy efficiency reached, but you did have a certain level of energy efficiency reached for, say, the lighting systems only, you could get what we call a partial deduction. The partial deduction doesn't exist in the new law, and I think the main reason that it doesn't exist is because we're now down to a 25% efficiency is all that's required to even get into being allowed to take some kind of deduction. Retrofit, the last thing we have on here. So under the new law, retrofit, so if you have an existing building placed in service for a certain period of time, you are allowed to take a deduction under 179D for the improvements made to the 3 categories of property. Okay. So again, this is a deduction for certain types of property that are placed in service. And this is sort of we've already talked about a lot of this stuff, but it's based on the size of the building, the overall cap, the energy efficiency obtained, and the years placed in service. With regards to REITs, there is a change in the new law that is relevant. So under the old law, the 179D deduction was deductible 100% in the current year for taxable income purposes. For E&P purposes, it was spread over a number of years. I believe it was 4 years. Now, under the new law, there is a 100% reduction in the year that the 179D deduction is taken for taxable income purposes and also for E&P purposes. So what is energy efficient commercial building property? It is depreciable property located on a building in the United States, and this reference standard 90.1, this is the base that I'm talking about, the baseline building that you use to measure your efficiency, your improved or reduced energy cost. And again, the property must be installed as part of the 3 things listed here. Now, the thing to remember about the 179D deduction, this is a deduction for costs that otherwise would be capitalized. We're not talking about things that are deductible irregardless. So for interior lighting, for instance, we're not talking about light bulbs, small things like that. We're talking about real improvements to the lighting system, heavy duty stuff, sort of. So, you still have your repairs and maintenance and your other rules that would apply. And if that cost is deductible otherwise, you're still going to go ahead and deduct it. You don't even worry about 179D. If it is required to be capitalized for some reason, then 179D can come into play and potentially allow current deduction for that property. This slide just goes over the maximum amount of deduction. So we've already covered this, but really it's based on the square footage of the building, and whether or not you get that bonus under the new law, it really changes what the maximum deduction allowed is. So you got to have a certification. So you have to have a certification to prove that you've met these energy efficient standards. You've reduced the cost of your energy usage. The secretary can provide additional guidance on what these certifications must look like. There is some guidance that's out there before the IRA came out. I assume that guidance would still apply, but it must be property installed, part of a plan to reduce the total annual energy and power cost with respect to the property we're talking about, those three categories of things. So you have to have that reduction in the overall cost. For the new buildings, it's compared to a reference building. The partial allowance, again, was allowed under the old law. So prior to 2023, after 2023, you're going to be in the 25% efficiency. So you're not going to get that partial deduction. And the reference standard building can change over time. It doesn't have to be the same exact standard. As everything gets a little more energy efficient, maybe the base building changes. Again, for calculating the amount of energy reduction, the secretary can provide additional guidance. The calculation must be done by qualified software. So on the IRS website, you can see a list of qualified software that can be used to do this. This software is going to have to produce the necessary forms, information, etc. You have to get a certification in order to take the 179D deduction. You do not have to attach that certification to your tax return in order to claim the deduction. But you do have to keep a copy in your records. Okay, so if it is a building owned by a tax-exempt entity, the tax-exempt entity generally is going to have no use for the deduction for the energy-efficient commercial building property. But what the tax-exempt entity can do, they can allocate that to the person primarily responsible for designing the property. Typically, what you're looking at is an architect, an engineer, or a contractor. There can be more than one person who is primarily responsible. And the tax-exempt entity has to allocate out the deduction. So you got to go to the tax-exempt entity, tell them what you're doing. You're going to have a certification, et cetera. So these things are going to have to be worked out with the tax-exempt entity. This is one that could be a really good benefit for the person primarily responsible for designing the property, because it's not a cost of theirs, but they can take the deduction. It is not included in income for the person taking the deduction. So who is a tax-exempt entity? Prior to 2023, so under the old law, it was only a government entity. That definition has been expanded under the IRA. So anything that qualified under the old law still is a tax-exempt entity. However, also included in that definition now is an Indian tribal government or Alaska Native corporation or any organization exempt from tax. So the potential owners of the building has expanded. The definition has gotten broader. The retrofit. So in an existing building that has been placed in service already, you can get the deduction for improving the energy efficiency. It's the same categories that we're looking at, nothing different. The certification is going to change in a retrofit. Instead of looking at a base building, you're going to look at the actual building. So you're going to have to test it within 1 year of the property placed in service and more than 1 year after the property has been placed in service. So the certification is going to be and testing is going to be based on the actual building. You're looking for the same 25% reduction or in overall cost. The thing about having to do it 1 year after placed in service, the deduction is going to be delayed a little bit. You have to have that certification, which cannot be done until 1 year after the property is placed in service. For a new construction, when you're looking at the base building, it's when it's placed in service. So it's going to be a little sooner when you can get that. The energy use intensity must be certified more than 1 year after. So a lot of the same rules apply, but the main difference is with the retrofit, you're looking at the actual building versus the standard base building. So qualified building for the 179D deduction, located in the United States, and this is the retrofit, has to be placed in service at least 5 years before the establishment of the retrofit plan. you're going to have to show the 25% reduction. Qualified professional is going to have to do the certification. Tax exempt entities can also allocate the retrofit deduction. So just like the regular 179D deduction, the retrofit can also be done by tax exempt entities allocated out to the person primarily responsible for designing the property or designing the procedures. There are recapture provisions in 179D. So if you don't meet everything you should have, you don't comply with your plan that you set forth, there can be recapture. Guidance is coming on that. The maximum deduction amount will be adjusted based on inflation and cost of living. So that will go up over time. It's not a stagnant number. All right, so that was 179D. Now we've got prevailing wage that comes up. So prevailing wage is something that's going to apply throughout all the IRA. So we're going to talk about prevailing wage and the apprenticeship requirements, and those are just big things that apply. So the prevailing wage applies during the construction and also during any alteration or repair work if it is done within a certain period of time. For the investment tax credit, it's a 5-year period after placed in service. For the investment tax credit, it's the credit year or the credit period of 10 years after placed in service. Before we get too into the details on all the prevailing wage, there is one thing to keep in mind, that the IRS is supposed to issue guidance on the prevailing wage and the apprenticeship requirements. Until this guidance is issued, you don't have to worry about it. You automatically meet the requirements, get the 5 times bonus for satisfying the prevailing wage and the apprenticeship requirements. The timeline is within 59 days of guidance being issued by the IRS and Treasury before you have to start meeting these requirements. So what you might hear being said is get this project started, because it's begun construction that you're looking at. When have you begun construction on your project? And there's a whole test on what is beginning construction, and we can help you decide whether or not you've done that or what you need to do to make sure that you begin construction. But the main thing is, until guidance is issued, we don't have to worry about this at all. Another question that comes up a lot, obviously, is when will guidance be issued? I know this is a very high priority with the government. I do not know when the guidance will come out. We'll get it when we get it. Unfortunately, it's the only thing we know for sure. I have heard early next year, because it doesn't apply until 2023 anyway. So early next year, that might, maybe then it might get delayed. We just don't know. So the requirement for the prevailing wage is that you have to pay a certain rate for the work of a similar character in the locality in which the facility is located. So you're focused on the type of work being done and where the facility is located. The act refers to the Davis-Bacon Act. This is an act that applies to government buildings that are built. So if you are doing construction work on a government building, you have to meet certain wage requirements. That is what this is sort of linking to, and that's looking back to. There are correction and penalty provisions. So if a taxpayer does not pay the prevailing wage, there are mechanisms to correct that. First thing that you have to do is the taxpayer has to pay the shortfall of wages. So the difference between the prevailing wage and what was paid to each laborer, plus an interest amount on that underpayment, has to be paid to all laborers. That interest is 6% plus the federal short-term rate. Right now, I believe the federal short-term rate is 4.46%. So you're looking at a little over 10% right now. That's a real number that the interest could be on there. There is also a penalty that has to be paid to the government. And that amount is $5,000 per employee that is not paid the prevailing wage. So there's two numbers and two things you got to pay. That penalty can be increased if the secretary determines the failure to pay is due to intentional disregard. We don't have a lot of guidance right now on what is intentional disregard, but the secretary can determine that. So that's something we'll be looking for additional guidance on. But what happens if the determination is made that the failure to pay the prevailing wage was due to intentional disregard? Is first, that shortfall paid to laborers, it's the same calculated amount, but you multiply it by 3. So it goes way up. The penalty per laborer that was not paid the prevailing wage is $10,000 per employee. So intentional disregard makes it a lot worse. The apprenticeship requirement. So the sort of the second piece of the prevailing wage and the apprenticeship requirements that go hand in hand to get your 5 times bonus. The apprenticeship requirement looks at the total hours on the job. And there are comments and requests for how do you define who's working on the job and what people are you focused on. And we can follow up later with additional guidance on what comes out. But right now, when we're just talking about the basic requirements for the apprenticeship requirements, we're looking at the total labor hours. A percentage of those hours must be given to qualified apprentices or performed by qualified apprentices. And it changes over time. So anything before 2023, we don't really have to worry about, because 59 days after guidance is issued, we don't even have to worry about the apprenticeship requirement. We don't have guidance, so we're not going to be in the 10%. So now we go to 2023. Once guidance is issued, we have that grace period, and then it's 12.5%. And then after 2023, 15%. And if a contractor, taxpayer contractor, subcontractor, anyone has more than 4 individuals working on the job, they have to have at least 1 apprentice. Okay. So there are some exceptions to the apprenticeship requirement. They're sort of good faith effort. If you make a good faith effort and don't satisfy, you're excluded from the apprenticeship requirements. The first one is that you have requested apprentices from a registered apprenticeship program and the request is denied. So the denial cannot be because of a failure to comply with the established standards and requirements of the apprenticeship program. If you agree to comply with their rules, you request, and they just basically say, we don't have an apprentice, or deny your request, you made a good faith effort, you're good. You don't have to meet the apprenticeship requirements. The second one is if the registered apprenticeship program just doesn't even respond to you within 5 business days after the date of the request. So if you get nothing from them, you're good too. And there again, if you fail to meet the apprenticeship requirement, like the prevailing wage requirement, there is a penalty provision that you can pay and be deemed to meet the requirement. The penalty initially is $50 times the number of hours short of the apprenticeship hour requirement. So you have to have a certain percentage of hours for apprenticeship time, $50 per hour that you miss that requirement. The intentional disregard, same thing, secretary determines intentional disregard, that penalty now goes up to $500 per hour that was a shortfall. There are certain employees, workers, laborers, etc., that do not fall into the apprenticeship requirement. So the foremen, superintendents, owners, these people are pulled out. Okay, 45 production tax credit. I don't think the PTC will apply as much to real estate. And the reason I don't think so is usually those are larger projects. But Baker Tilly can help with the determination of whether a production tax credit or an investment tax credit is more beneficial. So generally, you're going to have a product that is either going to fall under the production tax credit or the investment tax credit. Same product, same project, just falls under one or the other. You can't claim both. So under the old law, there was a base. So the production tax credit works with the amount of energy produced times a credit dollar amount. So 1.5 cents per kilowatt hour of electricity produced and sold to an unrelated third party under the old law. The new law is 0.3 cents, but again, we have this 5-time bonus requirement if the wage and apprenticeship requirements are satisfied. That gets us back to the 1.5. There are a couple additional adders. So we're already talking about this bonus 5 times that takes the base percentage up higher. There are additional adders. 2 of those are the domestic content bonus and the energy community bonus. So the domestic content bonus is 10%. Basically, to meet the domestic content, everything used in the project has to be bought from domestic manufacturers. US sourced products is what you need to do to get the domestic content bonus. The energy community bonus looks at specific geographic areas, and it looks at areas that are impacted heavily by fossil fuels. So coal plants, natural gas, and there's a lot of detailed requirements to be considered an energy community. But if there's a plant that's been closed, if there's high unemployment because less work, these are the things that are going to make it be an energy community. But the thing to remember now, I guess, is that if you're in an energy community, it's an additional 10% or up to additional 10% bonus on top of that credit. So with the steel, iron, or manufactured product for the domestic content bonus, they must be produced in the US. For the manufactured product, there's an applicable percentage that changes over time. So we start with 40% must be from US source, it goes up to 55%. So the steel and the iron has to be US source. Anything else, the manufactured product, has to mainly be US, and there are requirements. Okay, so again, here's production tax credit. It's basically, you get so many cents per kilowatt hour produced, sold to an unrelated third party. There's a 10-year period where you get this. The bonus we talked about, the domestic content we also talked about on here. This is the energy community slide. So if the project is located in an energy community, you get an additional 10% bump. So the investment tax credit. So really, you're going to be looking at the same project for a PTC or an investment tax credit. The ITC, the question is just which one's more beneficial to you. So an investment tax credit is not based on the amount of energy produced. It is based on the cost of the project. So under the old law, the ITC had been reduced right before it expired to 26% of the eligible basis. Under the new law, we're looking at a base for most credits. So there's different credits, but when we're talking about solar, for example, solar panels on a building, the base credit is 6% of your eligible basis. That's the cost of the property. Again, we have this bonus 5 times number, so that 6% can go up to 30 if you meet the prevailing wage and apprenticeship requirements. The domestic content bonus and the energy community bonus are also additional 10%, up to 10% potential adders on top of that. There is also something for affordable housing. So projects located in a low-income community or on tribal lands can qualify under sort of one of 2 groups, a 10% credit or a 20% credit. If you meet specific requirements, you get the 20, otherwise it's just the 10. This is a credit that is allocated by the government. So the way it works is you're going to look at the total energy output of the project, and the government is going to allocate you up to that amount of energy. If they allocate you 50% of your total output, you get 50% of your 10% or 20% credit, etc. There is an annual cap on the amount of energy that the government can allocate. Any unused amount roll forward. But, so the thing here is you have to apply and get an allocation. You can't just take it. The other credits, if you're eligible for them, you can take them. So the credits will phase out after 2033, And there is this technology neutral credit theory that sort of moves to. So um, once certain emissions targets are achieved, or 2033, you know, that's when you look at that you're going to start to phase out. That's how long the investment tax credit is going to last. The investment tax credit is transferable for years after 2022. So this is a credit that can be sold. The basis under the old law was reduced by 50% of the amount of the credit. That generally is the same rule. There is another benefit for affordable housing. So the Section 42 eligible basis is not reduced by the reduction for the investment tax credit. So you can take the investment tax credit and you do not reduce the Section 42 eligible basis. Here's a short example, sort of what we're looking at under the old rules and the new rules. At the top here, we have the credit you're going to earn. And again, right before the old rules expired, it was a 26% credit. Under the new rules with the 5-time multiplier, you can get 30%. So we have 30% in here as an example. Now you're going to have the basis reduction, so you're going to lose some depreciation deduction. So we've tried to tax effect the loss of depreciation deductions you would have and come up with a net benefit. So credit's good, you're going to lose some depreciation deductions. Here's where you're going to end up. And you can see going from 26 to 30%, the net benefit obviously goes up. Credit is better than having a deduction. Now remember that the 30%, you start with a 6, you meet the prevailing wage and apprenticeship requirements, you go to 30%. And there's all those adders. You have domestic content, you have energy community, you have affordable housing. So you can take that 30% even higher and you get even more of a benefit. So based on all the ones you can get, and you just stack on the credits. So it's just the first process is calculating what your percentage is. What do you multiply the eligible basis by? And the ones you qualify for, you just add on, and it can get higher and higher, and it's a really good thing. The new credit can be sold. We assume there's got to be a market discount when the credit is sold. The market has not really been clearly defined as of yet. So we're still waiting for it to work out. And I think a lot of the problem is it's a new law. It doesn't apply until next year anyway. We're still waiting to see for one thing, do the passive activity loss rules apply? So who are the universe of potential buyers of the credit? And I think even people who will be buyers, irregardless of that conclusion, are still waiting to hear sort of what all the rules are, looking for a little bit of additional guidance. They're trying to get comfortable with everything that's going on. Prior credit products or deals that have been going on for years and years, I think investors are very, very comfortable with. They know what to look for. They know what to expect. There's some new things here, and they just got to sort of get comfortable with the way it all works. A really good benefit for the sale of the credit. The sale of the credit is not taxable income. So this is beneficial to all taxpayers. You don't pay tax on the income you get when you sell the credit. For REITs, that means you don't have taxable income. You can't have bad income for your REIT income testing purposes. Okay, so the 48 investment tax credit. Again, you're looking at the energy property when it's placed in service, the basis multiplied by whatever your energy percentage that you're looking at. Energy property, there's a lot of different energy property. Usually what real estate is going to be looking at are solar panels. I think that's the thing to think about right now. And again, if you have something else you think might be eligible for the investment tax credit, you can definitely reach out to us, send us a question, give us a call, whatever, and we're happy to look into that for you, because there are other types of properties that are also eligible for the investment tax credit. The requirements: the taxpayer must be the original user. The construction, reconstruction, or erection has to be completed by the taxpayer, or the taxpayer must acquire the property before it is placed in service. So you got to be the original user. It's got to be depreciable property, and the secretary is allowed to prescribed performance or quality standards. They haven't yet, but they can. So that could be coming out. So with the investment tax credit, there are basically credits are broken into two categories, all the credits that apply. There are either 6% base or 2% base. Solar panels are under the 6% base. So that's why I've been talking about 6% as the base and the 5 times multiplier, et cetera, is because solar panels fall under the 6%. The credit, the amount of the credit is going to be reduced if you use tax exempt bonds in financing the property. It is the lesser of two things. 15% is the max you can reduce it by, or it's the percentage of the capitalized cost financed with tax exempt financing. So the thing to remember is if you are using tax exempt financing to pay for your investment tax credit property, you will have a reduction in your credit. Again, the basis is generally reduced for 50% of the credit. However, Section 42 eligible basis is not reduced. When we're talking about historic tax credit projects, so QREs, your qualified rehabilitation expenditures, any reduction is not eligible for QRE. I'm not sure how necessarily you would get solar panels or some of this stuff into being a QRE anyway. I don't think it would qualify, but it's clear that the reduction does apply for purposes of determining the amount of qualified rehabilitation expenditures. Okay, so this goes over first, you can get the 6% and the 5 times bonus to get you to 30%. Thing to remember is there's 3 ways to get this bonus. The project has a maximum net output of less than 1 megawatt. So it's a small project and it automatically qualifies for the 5 times bonus. Again, and also remember, construction begins before the 60th day after the secretary publishes guidance on what the wage and apprenticeship requirements are. So begin construction now, you don't have to worry about it. If you don't meet either one of those 2 things, you've got to meet the wage and apprenticeship requirements. And the secretary will also, as part of the guidance, be talking about recapture. So remember, we talked about all these credits that can be stacked. You can go from 6% to 30% and have these 10% adders, et cetera, all this stuff. Basically, the guidance is going to say that if you fail to qualify for some of the adders or the bonus or whatever, but still qualify for maybe the base, you don't get recapture for all of the credit. You only get recapture for the piece you don't qualify for that you thought you did and you claimed. Okay. The domestic content. So this is the base number for this is 2%, but it can go up to 10% if you meet the prevailing wage and the apprenticeship requirements. So for example, if you meet the prevailing wage and apprenticeship requirements, you had a 6% investment tax credit. It goes to 30 because you meet the prevailing wage and apprenticeship requirements. If you also meet domestic content, you go to 40%. So you get an additional bump on top of that. So again, this is where we're looking at the steel, iron, or manufactured product that is a component of the facility must be produced in the United States. And there are specific rules on the manufactured product, how you deem whether or not that is manufactured in the United States. Okay, so this slide is just with regards to the transfer of the credit. So an eligible taxpayer can sell the credit to an unrelated taxpayer. What is an eligible taxpayer? Basically, an eligible taxpayer is anyone who is not eligible for direct pay. So if you're a tax exempt entity and you can apply for direct pay for certain credits, get money back from the government, you can't sell them. Everyone else basically can sell the credits that are eligible credits. So the requirements when you sell it has to be in cash. It is not includable in income. So again, for REITs, that's a good thing because it can't be bad income because it's not taxable income. The transferee who buys the credit gets to use the credit, but does not get a deduction for state taxes paid when you have to make the election. So if you are selling the credit, you make the election on the tax return that includes the year the property was placed in service. So when you earn the credit on that tax return, by the due date, including extensions for the return, you make the election. The credits can only be transferred at one time. There's not multiple transfers of the credit. A partnership or S corporation is the owner of the property that places it in service. They're going to earn the credit. The partnership or S corporation can claim the credit, and they are the taxpayer who gets to sell it. The partner shareholder can't make an election. So if the partnership allocates credit out to the partners have the credit. We're back to the carry back 3 years, carry forward 20 years rule. You don't get a different exception. Again, tax exempt income. It's treated as tax exempt income at the partnership or S corp level, and it's allocated out to the partners. In a partnership, you allocate the tax exempt income in the manner you would have allocated the credit if it had not been sold. So you have to have an eligible credit to sell. It cannot be any of the credits. For what we've been talking about, the Section 45 production tax credit is also an eligible credit, but the Section 30C electric charging station credit and Section 48 investment tax credit. Those are the credits that are eligible credits that can be sold by the taxpayer. Section 30C, alternative fuel vehicle refueling property credit. Again, this covers a lot of different property, but for real estate, we're looking at charging stations. Under the prior law, the base credit amount was 30% of the eligible basis. Again, we have this same theme that we see in everything. The base percentage is 6% with a 5 times bonus if you meet the prevailing wage and apprenticeship requirement. So it goes up. There is sort of where the property is located. That really matters. So the property must be in a non-urban area. So if it's a non-urban area, you qualify for the electric charging station credit. And this is after 2022. If it is in an urban area, the only way it can qualify is if it is in a new market tax credit eligible area. So it's got to be in the right area, and there are maps and things. The urban area is a little difficult to look up. The new market tax credit, we have on the Baker Tilly website a map. You can type in a specific address and find out if it's within a new market tax credit eligible area. Again, this credit is transferable. So this is one of the credits that can be sold for cash. So we really covered a lot of this. So it's a percentage of the basis in the property. You have the 6% base, the 5 times bonus for meeting prevailing wage and apprenticeship requirements to take it up to 30. And you have to be in these certain areas to be able to claim the credit. If a tax exempt entity installs an electric charging station, for example, the person who sold that property to the taxpayer can claim the credit. So they can take the credit. They have to disclose to the tax exempt entity what they are doing. They plan on claiming a credit. So it has to be full disclosure and everything out there. The deadline is through 2032. Property has to be placed in service by the end of 2032. And again, this is a credit that may be sold. Okay, our last credit. Sorry if I'm running through all this a little too fast, but the 45L New Energy Efficient Home Credit. So this applies if energy efficient homes are manufactured, constructed, and sold to a third party. So the amount of the credit. Under the old law, it was $2,000 per home. So now when we're looking at single family homes or manufactured homes, the credit, there's 2 tiers. There's a $2,500 and a $5,000. So it's really based on how energy efficient the home is. The lower tier level is $2,500. The more efficient home is $5,000 per home. When we start with multifamily homes, we again have this bonus 5 times concept here. We start with $500 for the lower energy efficiency standard, $1,000 for the greater credit for the houses, meeting the prevailing wage requirement. The apprenticeship requirement doesn't apply for this credit. It's meeting only the prevailing wage. But if you meet the prevailing wage, your 500 goes to 2,500 and your 1,000 goes to $5,000. The basis is reduced generally for any credit taken. Again, there is a special rule for affordable housing. So the Section 42 eligible basis is not reduced by the amount of 45L credit. Downside with 45L, it is not a transferable credit. You cannot sell it. It has to be allocated out by a partnership to the partners, or it belongs to the owner, who manufactured the house and sold it. So it's available to an eligible contractor that builds an energy efficient building and sells it to an unrelated third party. Leasing can qualify as selling the property. Here I have listed all the different standards that you have to meet to, but you can see like the base standard for the $2,500 credit, how that's described. The zero energy ready home is where you get to the $5,000 or the $1,000 credit. Eligible contractors, some terms here. The eligible contractor is a person constructing the new energy efficient home. It includes a taxpayer who hires a third party contractor to build the home and sells or leases the home. It has to be qualified energy, a new energy efficient home, has to be located in the US, and it must satisfy the energy savings requirements that we listed on the previous slide there. Construction does include substantial reconstruction and rehabilitation. And the acquire, it's key to remember that not just purchase, it also is a lease that can qualify. You must have a certification, and like the 179D, you do not have to attach this certification to your tax return, but you must have it for your files. So there's a specific form and certain requirements that must be met. It's very detailed on what you have to do and what type of certification you have to get. Again, we've already covered the basis reduction with regards to this credit. The multifamily meeting the prevailing wage, you get an additional credit for. For multifamily buildings, there is guidance that's been out there for a long time. So previously, before the IRA, 45L only applied to multifamily buildings less than 4 stories above grade. I've heard some discussion and talk that maybe the IRA, that guidance doesn't apply. I would be very cautious about that. So until we hear something specifically, I would still assume that 45L only applies to buildings less than 4 stories above grade. Again, so the end of the 45L credit right now, as is enacted in the code, is 2032. So it applies only to homes sold before 2032. All right, the last 2 slides. So these last 2 slides focus on REITs and affordable housing. Some of the things that I think are very key to REITs. Section 30C, the electric charging station credit, and the 48 ITC are now eligible to be sold. And again, not taxable income, so not bad REIT income for the REIT income testing provisions. 179D deduction is now fully deductible against E&P. So those are some key takeaways for REITs. Affordable housing, again, the transferability of the credits is something that just keeps coming up for all taxpayers. But for affordable housing, the 30C and the 48 ITC can be sold. The proceeds are not taxable. The basis reduction, so a 45L credit and a 48 ITC do not reduce the Section 42 eligible basis. So with that, I think I've basically taken up all the time. I will say thank you. Sorry, I don't think we're going to get to any questions that we can field during the call, but if you submit them, I promise we'll get back to you on those. I will now turn it back over to Mike for some closing comments.
Yeah, thanks, Chad. Great stuff. Yeah, it's 12:57. We're going to cut it short by 3 minutes. I heard there's something very, very interesting and important going on in 3 minutes. So hopefully everyone's taking a lunch break to watch the World Cup game that's about to begin. But a lot of stuff there. We get it. It's confusing. Biggest takeaway: massive, massive opportunity. Very complex. We are absolutely here to help. So please reach out. We will get back to all the individuals who ask questions. We'll shoot emails out. We'll schedule calls. However we can help, we're here. We want to thank you again for joining. Sign up for our newsletter. Sign up for our website. Follow our webpage, bakertilly.com. You'll get some great information there on updates. But thank you all again, and go USA. Thanks.